All right, I think we're live. So James Eng with Full Capital. I don't have my partner in crime, James Wilson, on today, so I can't really I can't check the stream to see if it's working, but we're just gonna go as if it's working. So Anthony, appreciate you jumping on.
You got it.
Maybe give people a little bit of your background, and we'll jump in from there. I mean, I think the genesis of this was really a post that you put out about sort of like the top 30 things you learned after raising about 50 million in equity. And so we're going to get into that post. And then we've got Anselmo on with Velo. And so maybe Anthony, you start off, give us a little bit of your background, then we'll go over to Anselmo.
Yeah, well, my name is Anthony Walker. I'm an owner and the chief investment officer at Cornerstone Commercial Investments. We're based out of beautiful Coeur d'Alene, Idaho. We kind of focus on ground-up development, B-class apartments. We raise capital from LP investors. So far, we were founded in 2017, but really, built our processes and started raising capital significantly in 2019. And so far, we just hit over $48 million in capital raised. And that's pretty much been, that's kind of my full-time job, is raising capital. So I've been on, most of the investor calls. I'm the one talking to investors, every day. And so we've done that. And we have this year alone, we're trying to raise $40 million and to do more ground-up construction. We do it in Idaho, Montana, and in Oregon.
All right. And then let's go to Anselmo. Anselmo, give us a little bit of your background. I liked some of these comments that you made on the top 30, and then Anselmo was like, "Oh, let's get this guy on an interview." So Anselmo, appreciate you, spurring us on here. So Anselmo, give us a little bit of your background and then sort of what you guys do.
Awesome. Thank you very much for having me. So my name is Anselmo Torres III. I'm with Velo Residential. We're a third-party property management company based here in Dallas-Fort Worth. So our big thing is really utilizing technology to improve operations and efficiencies and help owners make more money with less stress.
All right. So let's. So I'm gonna pop up some of these. Hopefully you can see them, and then I don't know if you remember. I guess before we start, so I guess tell me the genesis of the post, right? Because a lot of people have raised money, but then a lot of people don't share sort of what they're learning. So I guess give me a little bit of the genesis of the post.
Yeah, totally. So I've really dove into this, raising capital last few years, and I'm obsessed with learning. So I listen to, I'm the person that's at the gym, not listening to music. I'm listening to podcasts, trying to figure out how to raise money, getting coffee with people who've raised billions of dollars. And so I've learned a lot the last few years of how to raise capital. And, that's kind of what's got me to that. But also I like the idea of giving back. So, I'm launching this podcast, as I mentioned a little bit ago, but I want to give back and try to help people along the way, because it's tough raising capital. I mean, today more than, it's been the last few years. And so the genesis was just, kind of motivation to show people, but as well as those are truly things that I'm learning along the way.
All right. So let me see if I can get this. All right. So number one. So I always have trouble when people ask me like, hey, tell me about this post from like 3 months ago. Like, I'm like, I don't exactly remember that post, but so hopefully you can see these.
Yep, I can see them.
Yeah. So let's start with number one. If you invest in the deal, or if you invest in the long term, you win. So let's start there. Number one. So give your comments, and then Anselmo and I will maybe follow up with some questions from there.
Yeah, I mean, you're seeing this more and more today. I mean, you just saw that massive portfolio go to foreclosure in Houston, and if you look at their offering memorandum, it was, I think it was a 2-year hold, a 50% average return in those 2 years. And it's just like those numbers were just crazy, And so if you invest, in my mind, if you invest in a real estate and you plan on holding it for a longer term, you're gonna make money. So if you build a project or you buy a value add, you stabilize it and you hold it for 5, 6, 10 years, you make a lot of money. Also with that, a lot of people have to look at refinances along these projects. It's not just real estate, especially real estate isn't just a quick game. It's a long-term generational wealth kind of game. And a lot of the wealthiest people I know, who have billions of dollars, they sell projects they bought in their, 20s type of day. They bought, we have one of our biggest investors. He bought projects in California in his 20s, and he's almost 70 now, so 50 years ago, and he still has them. He just refinances them refurbishes them and keeps on renting them. And he started from a triplex, and now he owns, he has over $1 billion in real estate. So, that's kind of where I get those lessons from.
So I'll jump in here. So from the construction standpoint, so this is the first time you and I have met. So hopefully I don't ask something that like just throws you way off. But so how do you guys, you said you do ground up development.
Yep.
How do you structure your debt then? Do you do HUD? Do you do regional bank loans and then go to Fannie Freddie? What's typical structure for you guys?
Yeah, typically we'll get a regional construction loan. So,
Okay.
Local bank, we have good relationships with, all the banks in our area. We'll get a good construction loan that's typically a 30-month interest only for when we're building it. Typically we have a little bit, leeway. Typically our, construction costs takes about 12 to 18 months. We always have buffers in there. And then on completion, we'll stabilize it. When we hit 95% occupancy, we'll refinance, typically into a 5, 7, or 10-year Fannie Mae interest-only product.
Okay. All right. So let's go into number 2 here. Let's see. Number 2. All right. Anselmo, jump in at any time, please. I'm just going to keep going. So cash flow replaces your time. Appreciation builds your generational wealth.
Yeah, absolutely. So, everyone wants to be financially free in this industry. That's why a lot of investors, start out in real estate. That's kind of their first itch, is to replace their income with passive income. And so that's kind of the idea, cash flow replaces your time. You can step away from your W-2. You can, go sit on a beach in Mexico if you want. You can spend your time exactly how you want it through cash flow, because you can pay for, all your day-to-day needs. But on top of that, you have appreciation, and that's what you pass on to your kids, or that's what, truly builds the generational wealth. When you buy $1 million asset, and let's just say in 10 years it's worth $2 million, that's where the real wealth is built. And that's the wealth that's easier transferred to your kids, because, you have step ups in basis, and you have a lot of, efforts, as long as they, they get those assets. And if they're managed correctly, they get that cash flow as well.
Yeah. I mean, I've sort of I started investing in 2015, and majority of the deals that I were looking at were pretty much just like 5 to 10% cash on cash over the whole period. And then, most of those deals sold. And so, you really got sort of that equity piece at the end of it. But then I think if you did buy a deal, let's say on your own, and you sort of passed it on to the next generation, because it's a little bit harder to do that in a syndication. Like if you bought a 20, 30, 40, 50 unit deal and then just trade the debt up into 100 to 150 to 200, and then pass that on to your kids. I mean, it's a huge difference maker on.
We have both, and we have investors, even in our syndication deals. We have some older, retired people that put the money in there. The idea with, passing it on to their kids, they get the, they have it in their trust, and their idea is to pass it on, the cash flow and the, additional appreciation, as well as we have a lot of opportunities on investments. So that's a lot of really good tax advantages for them. So in 10 years, it's tax free. So that's another, huge thing that our company does.
I've been on LinkedIn for a long time, but one of the in the past, you've seen the conversations about, hey, what would you rather have, like equity or appreciation or cash flow, like in your investments? So I think do you think that's shifting now with kind of what's happening in the market?
I don't. I mean, I think the thing about cash flow is it's everyone's focus when they first start investing, but there gets to a point when you have enough cash flow, you're like, what do I do with the excess? Once you get to that point, that's when you have to see a lot of investors then focus on the appreciation. How much money can I make with this, in 5 or 10 years, and pull it out, But I think that it's kind of it's a balancing act. When you've invested enough, when you have enough cash flow, then it's a switch. And I think that that's never really going to go away. Even with, interest rates, cash flows, going down and whatnot, people still want that, because, most investors' first goal is to replace their income.
Right. Okay. All right. So this was, and I actually wanted to get your comments on this because, so number 3, pessimists are often right and optimists are often wealthy. So I want to hear your commentary, and then I'll just throw on sort of how I think about this in my head, because it seems like it's a constant battle in my field. So, all right, go ahead.
Absolutely. And I'll start this with, I'm a very optimistic person. And sometimes, I have great business partners who, taper that down maybe a little bit, but I'm a very big vision type person. And so, sometimes optimists, I'll start on the back end. Sometimes optimists go out there and they fail and fail and fail, and then they find success. That's where a lot of the wealth comes from. You see a lot of people like Elon Musk, who's, very optimistic. Look how many failures he's had before, he's one of the wealthiest people in the world. Whereas you have pessimists, on the other hand, who are constantly like, realists, looking at things, that probably won't happen. And if you constantly think something won't happen or you can't do something, you're right, because you never end up doing it. So that's kind of where that comes from. I've met a lot of pessimists. I've met a lot of people who talk to me about my deals who, they don't want to do it because they look at all the, negative parts of development. What happens if the development fails? You only get halfway built. What if you never get leased up? You only do these different things. And it's if you get stuck on all the negatives of a deal, that's probably going to happen, and they never end up at investing. So they're right, because they never make more money. They're glued to their foundation. Where optimists look at it as, what's the odds of us building a 50 unit infill project in a super good location? We're signing recourse loans as the general partners. What are the odds that doesn't get done? We have good reserves. We have all these different things. And, we're optimists in the fact that, like, it's 50 units in a great location. Like, the odds of it not leasing up are very, very low. And so we're just constantly pushing that. And we just get that constant report back from, pessimistic people that, if you look at negatives, they can become true every single day.
Yeah. I mean, a lot of, so in my space, so I finance a lot of properties, right? So, like, bankers always look at the downside of every deal. Like, that is just in their nature. So, like, in my previous career at GE, I was an underwriter, and my job was to uncover all the negatives of the deal. So that was my job. But then at the same time, you had to mitigate all of those risks. So if you pointed out a risk in a deal, they asked you, all right, great. How are you mitigating that risk? And is that sufficient? And so there was a whole page in our investment memo that was risk and mitigants. And that chart got the most time in the investment committee. Wow. The entire time. Like, everybody's like, all right, yeah, we get it. This is the market. This is the property. I got that. But then what are the big risks in this deal? And let's go through that. And so, when I moved over to Old Capital, my job is a little bit more on the origination. So I have to balance what the bank is saying, right? They're typically more pessimistic, more risk heavy. And then the optimist on the borrower side is typically, their pro forma is usually the highest pro forma, right? And so you're balancing those two things and trying to make sure that it all works out. And, even when I invest in a deal, a lot of these deals, you never know, right? You never know 100% certainty. But the guys that I've seen who have done well, they've put money down on the table, and they've taken bets, and they've tried to be as strategic as possible. And they are often wealthier than the bankers. And so, so the general partners who have taken the risk, put some money down, those people are wealthier. So, all right.
It's both aspects. It's the same with me. I mean, the wealthiest people I know took those massive risks, even if it's in real estate, buying land that's unannexed in a city. They're like, the thing about it is you take the risk, but then you look at the downside is there's always a solution most of the time. I'd say 90% of the time there's a solution to that risk. If you get caught in current, predicaments or whatnot. Another thing you said about, a lot of borrowers, their pro formas are the best case scenario. Something that we do is we underwrite exactly as Fannie Mae would look at it. So my business partner worked with Fannie Mae for 20 years. And so we underwrite it exactly how Fannie Mae would, underwrite the deal. So we just turn in our pro forma, and they're like, this is exactly what we want. And, those are what our projections are based off of. So ideally, we're overperforming on our assets. But it's already, it also looks good because we're, cost engineering the product and everything to make sure it, fits within that pro forma guidelines.
And I'm just going to go on a sideline here, but have you guys looked at HUD for development?
Yeah, we have actually more now than previously. We're exploring it more and more. We're looking at some non-recourse options in construction, as well as HUD for bigger developments and stuff. We've kind of gotten to the point where we have some massive opportunities. I mean, we've gotten opportunities probably to build 1,000 units in Montana over the last 6 months to a year. And so we're looking at definitely different financing options, different leverage packages. Big thing for us is we don't want to take on, massive amounts of recourse,
Sure.
especially as
Yeah.
we're growing.
Okay, perfect. And Selma, anything to add? What are you seeing on the management side for
Well,
Pessimists are optimizing?
it's funny you mentioned the pessimists being the bankers, and then I think about the optimists being the brokers. On that opposite end of the spectrum where they're. But for you, Anthony, I think you have to be an optimist, right? If you come at me with this new development and you're selling me this dream, I'm hoping that you're an optimist. Because if you come at me as a pessimist, there's no way I'm giving you money. So you have to be an optimist.
Yeah, and it's constantly a question, what are the negatives? So I actually think we're going to put that in our pitch deck. Why would you not invest in this development? Because we constantly get that. So we're going to get to a point where we put it on the table, like these are the risks. These are how we're mitigating them, exactly like you kind of said there. We're going to actually add that to our pitch deck because there's, most investors, I would say the syndicators, the developers, they're the optimists. A lot of the investors are a lot more pessimistic. Well, and a good thing. They're optimistic probably in some parts of their life, but they're always pessimistic on an investment because they're trusting someone with their money. So it's a constant thing that we have to battle.
All right, I think we got that one. All right, number 4, invest in location over scale. So you sort of touched on this one. I guess you said you were doing a 50-unit deal or something like that. So maybe touch on that or touch on one of your other developments.
Yeah, totally. I mean, most of our developments, I think actually every single development we've done, besides 1 or 2, have been in, infill locations. So we love the locations. If it's, we just finished a project in Missoula, Montana, 54 units. We finished the 42 plex and we're just finishing the 12, but we got to lease up the 42 units early, and it's right across the street from the biggest health center there. All 42 units were leased within a month. So
what's the address on that deal?
I'd have to,
or just what's the name of it? What's the name of it?
Yeah, it's Fort Grounds.
Fort, how do you spell it?
Fort Grounds, FORT Grounds Apartments.
Okay. All right.
Yeah.
Cool. I just want to pull it up because I've never been there.
So location matters. I mean, that's
location is amazing. And like we just finished leasing up a 53 unit in an opportunity zone here in the Coeur d'Alene area. And it's walking distance to restaurants, it's walking distance to the river, to big parks and stuff, which tenants love. If you're and our idea there is, if the market does soften like it is softening today a bit, our stuff all stays full because the tenants love to live there. Would you rather live in a location that's near amenities or near downtown or near your work, or on the outskirts of town in this 300 unit that they just got annexed in that has nothing around it besides a field? That's kind of our philosophy, and it's done well for our investors, as well as typically you can charge a little bit better rents because of location. It saves money on having a commute, saves time, and people want to pay $1,500 more a month for that, which just goes straight into our pro forma to returns to our investors.
So how people are worried about construction costs nowadays, or they used to be worried about construction costs.
Yeah.
What is the typical, like, are these 3-story, 4-story garden types deals, or they have elevators, or what type of product are you building?
Yeah, we do both. So we do 3 and 2, and I should say most of the stuff is 3 and 4 story. 3 story is going to be walk up, class. We put quartz countertops in. We have silver, gold, and platinum packages. Silver being the much more affordable. Think laminate countertops. Gold is mostly our product that we build, which is kind of a step up above that. Typically it's a little bit longer hold, so we'll put quartz counters in it, and just a little bit better finishes. Then you have platinum, which is just really good location, better amenities all around. And so construction costs have been a worry the last 2 years, and they really lumber's gone down, but everything else has remained pretty steady. So we do significant cost engineering. Like we just got done in our 3rd round in our project over in Bend, Oregon. We're about to break ground on. We're raising capital for that one right now. And, we looked at it, every single aspect of it. We were to cut off about, it's a $12 million build. We cut off, our first bid was $15 million. So we cut off about $2.5 million, but just by looking at a cost engineering it, and that has $1 million, $1.2 million in contingency. So, we've significantly cut that down just by looking at every aspect of it. What countertops we're putting in, what cabinets, how big the kitchen is, cutting kitchen islands, and just looking at those different items.
So $12 million was total cost. That's land
Yeah.
and improvements. And then how many units is that?
42 units. So that's
42.
yeah, that's in Bend. That's in a good location as well. That's on the it's on the canal, so it looks exactly like a river. So every single unit's going to be have river views. So, and that's with $1 million contingency and large reserves. So ideally, we have a good builder there. We don't tap too much into the contingency, and we can distribute that back to investors for total project cost at 11 and a half or so.
So you said that's in Bend, Bend, Oregon?
Yeah, yep.
Okay.
And the project right behind us is a little bit not quite as nice, and it's it's just getting listed for over 350 a door, and ours are all 2.2s. That has a lot of studios and stuff in it, so that's that instant appreciation, building under market value that we like.
And remind me again, where do you live?
I live in Coeur d'Alene, Idaho.
In Idaho. Okay.
Yep, Coeur d'Alene.
All right. So Dallas. All right. First, Anselmo, let me go to you. So what's the size of your properties that you build typically, like in number of units?
Most of the time they're 50 to 150, but we're looking at some bigger projects as well. We're looking at a project in Bozeman that's 264 units, but that would probably be a two-phase project. So most phases, if we're doing a bigger project, will be that 100 to 150 unit range, and that's kind of where we want to be.
Okay. And Selmo, how does a lot of times, like here in Dallas, a lot of projects are big, and they'll be we'll have, let's say, 200 units, suburban location, 2 in, 2 out, and that's how we manage it. So how would you manage some of these properties, Anselmo, in terms of, because these are smaller, right? So we'll see some of these 50 unit deals in sort of uptown Dallas, maybe East Dallas. But when you go out further, there's really not that many 50 unit deals in the suburbs. So
we would, we utilize technology, so that helps us improve, operations and efficiencies. A leasing agent doesn't exist in our world. So we typically take that off the payroll right away and implement our virtual services team. So that helps us be competitive and take advantage of that 50 to 150 unit range. Now the more units you bring us, the more efficient we get, and the better we look, especially from James mentioned 2 in, 2 out. We'd start looking at taking off a leasing agent off of that payroll, so you're looking with at least one less individual on that payroll.
All right. I just saw this question pop up from Brian. I think this is for you. How do you select your market for development out there?
Yeah, and I was going to say really quick on the 50 unit mark as well. On the management side, we typically like to go into a market and buy 100 or 200 units to get started. So that way we have if it's a 50 here, a 50 here, a 50 here, we can have a leasing center at one of them type idea, and they can help manage them. Like we're looking at a project in Kalispell, it'd be 141 units between three different areas. But that way we can have one manager that rents them all. And we choose a market. We like the tertiary markets, so the really high growth markets. All the markets that we're in, Bend, Oregon, markets in Montana, markets in Idaho, they've all seen, a ton of growth over the last, 10, 20 years. And that continues to happen, especially as COVID hits. So most of our markets have 2.5% to 5% population growth a year. And so that's kind of how we choose it, as well as there's a lot less, you guys are in Texas, a lot more, institutional demand there. We don't have a lot of institutional demand here, but it's starting to come because so many people want out of California. So, we can build a 7 cap up here, and they want out of California so bad. They want to sell their projects down there because landlord laws are terrible, and they sell it at a 3.5, 4 cap up there, and they're willing to buy a 3.5, 4 cap up here. That's changed a little bit with rates coming, but last year, there was 2 projects that sold at a 3.5 cap in our market, and that's never been seen. And additionally, you can still, the one project that was sold at a 3.5 cap was only 250,000 a door. So you have that, which is pretty cheap per door compared to like a Seattle market. So we just believe we have a lot of appreciation to go in these markets as they grow.
Got it. Got it. All right. Very cool. Let's go to number 5 here. So reading opens up your mind to the world's possibilities. Action is the only thing that truly matters.
Yeah. I mean, we've all read, tons of books, one of, most people's favorite real estate book, Rich Dad, Poor Dad. I read that before I got started. That's what kind of got me obsessed with it. And then from there, I've read dozens and dozens of books about real estate, about mindset, but none of that really matters unless you take it and you implement it, whether it's into your business or into your life. And if you read Rich Dad, Poor Dad, but you don't take those philosophies and implement them, then it really doesn't matter. Or, you can't see it, but right above me is a book called Traction. And we run our whole business basically off that book. It's the Entrepreneur Operating System. And every employee is, indoctrinated in a way where, they're small entrepreneurs inside of our business. So they're more creative. They, feed our business more. They have new ideas. And all that comes from reading, but then putting that, reading into action.
So I have that book here, and I cannot get through it. Like I'll read it. I'll like start on the first chapter, and like most books, like I got I don't know if you've read like Psychology of Money, that book.
I've not.
Okay, so Psychology of Money, like I literally picked up the first chapter and I couldn't put it down till I
didn't
finished
read it.
So, but I don't know if it's maybe I think it's more sort of chief operating officer type reading, and so maybe my mind isn't like wired for that. But yeah. But
the only reason I read it, and I would say the same thing. If I wasn't trying to do this, type idea, I wouldn't pick it up. But Brandon Turner, Bigger Pockets podcast, he lives and swears by that book, and so I know him. He actually lives in Coeur d'Alene, or bought a house here in Coeur d'Alene, and he's like, this is how you should run your business. And we're also a company of, we don't need to recreate the wheel. We can take the wheel and make it a better wheel, and implement it different ways. And so that's the whole reason I read it, is because he was like, this is the best way that I found to run a business, especially a startup. And he went from 0 to 7,000 doors in, who knows, like 5 years or something. Sure. And so I was like, we would love to learn those philosophies as well.
All right, that's okay. This is the question I actually had from this is, so when I read a book, I usually have my phone next to me, which I try to separate those two things, but I will take notes on my phone while reading the book. And then pretty much I'll go back to those notes. But then if there is something that like I read in the book and I'm like, man, I need to take action on that today, I will just email it to myself. And then it sits in my inbox until I do it, which will drive me crazy. But how do you, when you're reading, how do you get it to that action piece of the puzzle?
I do the same thing actually as you. I have my notes app open. I do the same thing for reading and podcasts. So if I'm listening to a podcast, I'll pause the podcast and write it down so I can revisit it later. And same thing for reading. I'll take a snippet and I'll write it down and try to implement it, or I go back or sometimes I highlight it if I want to read it again. But most of the time I take notes on it. I take a lot of notes, and I have an iPad that I have like the little handwriting thing, and I typically just handwrite the note out.
All right.
One thing too is there was a point in time there where I felt like, man, I need to read 50 different books, right?
Yeah.
And I did that, and I wasn't taking any action. But then I started reading like the 2 or 3 books that I really enjoyed, and I actually did something with what I read in that book. So I find myself doing that now is, hey, going back to those 2 or 3 core books, rereading them, because those are the ones that made me take action.
Yeah. I listened to.
And Selma, what were the books? You can't leave us hanging here. What books? What's your top 2, 3?
Tribe of Titans by Tim Ferriss.
Oh yeah, sure.
I really like that book. And then the Steve Jobs book. That really helped. The
biography?
Me. Yes.
Okay. All right. I haven't read that one.
Yeah,
I think I'm discouraged by the size. Okay. All right. Let's. We had a question come in from Chan. He says, Anthony, maybe take this one. How do you come up with total cost per unit? I think he's trying to say, like, how do you make sure you don't overbuild, right? So if you come in at 300 a door in a market, and then are you checking comps? Are you trying to be like, what type of buffer do you give yourself? Because obviously if you build to 200 a door, you sell it for 300, that's great. But if you're on the other side of that deal, that's not great. So maybe talk about that.
Yeah, 100%. So we have a property manager there who manages, in our markets. We typically go with bigger property managers because we want them to know the market. And so we go to them, we ask them what we can get for, we have a bunch of buildings design type idea. And so we typically know our, 900 or 1,000 square foot for a 2-2, 600 to 700 square foot for a 1-1. We'll go to our property manager at our location and see, what we could get for rent there if we build, with these, rough, quartz counter, stainless appliances. What can we get for rent there? Typically take that rent, we lower it by 5-10% just to be conservative in case demand softens at all, and then we put it into the pro forma with 5% vacancy, with and you probably our average on completion expense ratio without vacancy is typically 25 to 27%. We plug all those numbers in, and then we plug in rough building costs, and what that needs to be, and then we get a number based on returns. So if that first year we're trying to have a 25 to 30% IRR, that's basically your built-in equity, your equity under market value. And then we look at the cash flow. So look at the two metrics there, and if the cash flow is 2%, then we're going to go back to the table and say, what do we need to cut to still achieve the rent we can, but try to cut it down to those building costs. That's exactly what we did. We worked with our property manager, we worked with our builder, and we looked at every aspect. We took off metal siding, we took out the kitchen islands, we took out, we shrunk the units a little bit. We went from, just over 1,000 square foot for the 2-2s down to about 950. But when you're talking, 70 square feet at $200 a square foot over, 42 units, that's hundreds of thousands of dollars in savings. And that's kind of how we do it. So we make sure conservatively we hit the numbers for our investors. And then ideally we have the, and that's with contingency. Ideally when we're done, we, get the market rents or more that we were, our property manager told us, because we were conservative on them. We don't use a contingency, and we overperform for our investors. They love us. They invest more.
The couple of follow-ups I was going to have is, when I'm looking, so thank you for doing that underwriting piece, because understanding the market rent, starting at the top of the P&L and then going through the pro forma vacancy. So did you say your expense ratio is 30%?
No, it's without vacancy on new construction, we're hitting about that 25 to 27% range, pretty much across the board in all of our markets.
Okay. So maybe I think your taxes are lower. So I think taxes, maybe insurance are lower. And then what are you using on like a residual cap rate right now?
Yeah, most of our markets now we're using about a 5.5 cap.
5.5. Okay.
So,
all right, gotcha.
Ideally we're not selling any of our projects over the next 2, 3, 4 years.
Sure.
And ideally, they're closer to that 5 or under range, but we'll underwrite them at a 5.5 cap today. A year ago, we were probably underwriting them at like a 5 cap. And yeah, you're right. Texas has much higher taxes than we do in Idaho and Montana specifically, and even Oregon.
Okay. All right. Let's keep going. Number 6. No matter how good your returns are, someone will hate it. All right. What's the thought on this?
I mean, this kind of goes back to the pessimistic type thing. You can show everyone every single number. You can show them the entire development and investor, and they're still not going to like it. They're still going to hate it for some reason. There's people out there that will come up with a reason to hate something no matter what. And that's anything in life. You could be launching your podcast. You could be doing this live right now. We're doing it, and someone's going to hate it for some reason. And that's just life. You have to learn to, take them. Maybe there's a lesson to learn, and then, put them aside and focus on the investors that believe in your vision and believe in your company.
So let's just maybe take one project, and let's say, so you invested, you've raised $48 million approximately in equity. Yep. What's the typical equity check that you guys are raising for in a deal?
Yeah, our average is right around $225,000. That's our average across the board investment.
Okay, no, sorry. Total equity raise. So like for
Oh,
one project, what are you typically raising? Like 5 million, 10 million? What's the typical total
yeah,
size?
I would say on average, it's probably um, getting bigger now. I'd say right around that $10 million range. I'd say our average has been 5 million. Now we hit 7, but now we're about to launch a 21 million. So just as our company grows, those are getting bigger and bigger. So,
So at
but
10,
I'd say our average so far has been around 7.
okay, let's just say, all right, I'm just gonna use 10 million because it's
Okay,
easier.
easy.
So $10 million, like how many investors do you go out to raise $10 million? And then what's sort of like the ratio of people that invest versus don't invest? Because I'm
Yeah,
always,
great.
yeah. Okay.
Great question. So, until actually this year, we've grown our entire business off of word of mouth. So, getting coffee with people, we really wanted to build our processes and have the best process possible, and then impress people so they tell a couple of their friends. And the first $40 million we raised in our business roughly was all pretty much word of mouth. I mean, sending out emails to people, like I said, getting lunches with people. This year alone, we launched some marketing campaigns, which is much lower percentage per investor. So if you get 100 investors, if you get one to invest or two to invest type of deal, you're doing decently okay. But I'd say right now we'll send it out to about 1,000 people, and from that, on a $10 million investment, you'd probably get 50 or so investors.
Okay. Yeah. All right. So 200. Okay. All right. Gotcha. But you're thinking that majority of the people are really um, coming in because of referrals more so than anything else.
Yeah, I mean that's
Yeah.
where most of our stuff has grown from. So they invest. We have a lot of investors who invested in every single deal. Whether or not we have some. They want to build a generational wealth, and they'll put $50,000 into every single investment. We have some that put in a couple 100,000 in every investment. But then they tell their friends. We give them good returns. They tell their friends, and that's kind of how we prefer to grow. It's the cheapest way and the most effective way. But it's also slow. So that's why we've implemented more of the marketing, is to speed up that curve, impress more people so they start telling their friends in different markets.
What's funny is I think you could replace the word return with loan. Like no matter
Yeah,
how good your loan is, someone's gonna hate it. And then you can also replace it with management. No matter how good your
absolutely.
management company is, someone will hate it, and you've just got to move on. And
Absolutely.
and at what point when you're raising equity, do you feel that? Like, do you feel like once you've talked to someone and they've, maybe they have one question, then that leads to 5, then it leads to 10, then it leads to 20. It's like, maybe this isn't the right investment for
Yeah.
you.
I mean, you'll have it instantly. I had someone reach
Yeah.
out yesterday and say, "Hey, saw your stuff. It looks pretty aspirational. Not interested." Like basically saying our metrics look, higher. And so I'm
Yeah.
like, no problem. Like, here's our pro forma. Here's kind of what we're estimating off, and here's also what our property manager, who manages 1,000 units in the Bend market, sees as
Yeah.
well. And still, just nothing. He just hated it because he saw a number, didn't like. He thought the number
Yeah.
was too good to be true type idea.
Sure.
And then I'd say, probably the second conversation you can really feel if someone's is interested or not. And, at that point, you just see what they're gonna do.
Yeah, I mean, I heard it yesterday on a podcast. Basically, like if you cannot accept no, as an entrepreneur, then you're not going to go that far because
Yeah.
you're gonna hear no 90% of the time. That
Yeah.
10% of the time, it's even lower. It's
I
you
mean,
are
get it
5% of the time. You are 5%. 95% of the time, you're gonna hear no. So,
any successful entrepreneur should do a sales gig to start with. I started in residential sales, and you get thousands of no's before you get a yes. But it's all about the hustle. It's a numbers game in sales, in my opinion. The more people you touch, the more no's you get, the more yeses you get.
absolutely. All right. So all right. Number 7, we'll roll straight into communication is key to any successful business. So, when you wrote this, were you thinking internally? Or are you thinking externally? What are you thinking?
All of the above. So internally, if you have business partners, if you have employees, having clear, concise communication, that way the projects run efficiently, smoothly, especially in our case, and externally. So we have investors, and we had a call with one of our investors that we recorded a recording testimonial, and his number one thing that he enjoyed about Cornerstone was our communication, meaning that when he asks a question, we answer it within 24 hours. Because we have this investor in particular, we probably have $500,000 of his invested, and he's not our biggest investor. He's probably the middle line, but we make sure every single investor gets perfect communication because they're trusting with their money. You know, they worked hard for their money. And so we have great communication with them. So they know exactly what's happening in the development. If there's any issues, you know, we're transparent, we're open with them. And for that, you know, that investor, what I'm talking about, has also invested in every single one of our deals.
Yeah. I mean, I typically get maybe like a monthly report from general partners, and then maybe if there's maybe at the beginning of a deal, you'll have a little bit more for capex. But here, this guy, let's see, we got another question. So I don't know if you've seen this. You maybe have.
I
I
have,
think.
yeah. That's what I was
Okay, you've seen it. All right. So
I mentioned it a little bit earlier, yeah.
okay, so like I think if we were to generalize it, I don't think their communication was that good on this deal. Just because of yeah, they bought it for 75 a door, but then they sold it for 50 a door. So
Yeah.
something was off there. So you can't just look at price per door, right? So price per door is one metric that you want to look at, but then you also have to look at the rents, you have to look at the management company, you have to look at the sponsor. And basically why he defaulted on the loan was really because of not only the management company, but his interest rate essentially went from 3% to 8%. So on a floating rate loan. So he didn't have the money to pay for it. And if the properties aren't performing, you're not going to be able to get there. So
Yeah.
hopefully that
I mean,
answers your question. Yeah.
this is a perfect example of, as well as, you know, if you saw the offering memorandum on this, he was offering like a 50% average annual return, which is just crazy. And then the second thing is over leverage. You know, this company raised, I think it was 80 or 85% leverage, plus they raised additional equity to give back investors while they were, you know, turning over the units, increasing rent to get that return. And so I saw a Twitter feed on it. Someone broke it down and they were like, at the end of the day, they were 93% leverage. So if interest rate goes up a point, you're negative. You know, your cap rate goes up from, you know, if you bought it at 4, it goes to 4.5, you're negative equity. And that's why leverage is so important. I mean, all of our developments, we raise at least 40% equity on them. And then when we're done, stabilized, if we want to give back some money or refinance at a better rate, we can. But leverage is arguably the most important part in real estate.
You know, and I want to emphasize too the importance of communication right there. It's key. It's easy to communicate when things are going well, but it's just as important to communicate when things aren't going well. You know, especially in property management, there's things that happen. You know, there may be sewer lines that go down, and you've got to make that call and let the owner know, hey, you know, it's going to cost this much. So, you know, that communication is important. So I mean, even in bad times.
Yeah, we've let property managers go because they, exactly what you said, they had poor communication and they felt bad telling us something. And we're like, especially even if it's not their fault, like something broke or a tenant did something, we had a property manager that like feel bad telling us, and then we're like, we'd rather just know, get the problem fixed and move on. You know, pay once, cry once. You know, and it's just, and when you have bad communication on property management, that's a no-go for our company as well.
What's your for projects that are already going, how often do you communicate with the investors?
So if an individual investor reach out to us about a question, we'll answer them within 24 hours. But if not, we send out monthly updates, and then we do quarterly, just all, company updates type of deal. But every project we'll do a monthly update on. Do
you have a drone set up for your developments already? that would be every month. I just want to see the drone flying over the project, showing me how it's going up in over time. Yeah,
absolutely. We do actually. We have Caden, our media director, and he goes and shoots drone photos. So if you look at we do video updates for our investors, as well as we're doing a project in Montana right now. We're on the second floor framing, and we set up a camera to record the entire development process, so we can, send it to our investors at certain increments, but as well as when we're done, kind of show them that full development process.
Have you put that on LinkedIn? You should put that. If you have not put that on LinkedIn, that'd be very cool to see. I have not, but I will. Okay, yeah. So I would. So I mean, like we had someone change out our roof for like a 200 unit property, and they put a camera there, and they showed pretty much. They sent me like 1,000 pictures. Like every 10 minutes while the guys were working. And so if there was any idea like, oh, I don't know if this guy did the job. Like you have a snapshot, a timestamp, like every 10 minutes, which was crazy. I didn't go through all the pictures, but it was just showing that the work was getting done. So
That's what we're doing, this 4-story elevated service building in Missoula, and we're on the 2nd story framing, but that's what it's going to be. So it's going to be 18 months of a picture basically every single day for 18 months, and it's just going to be a video that they create, but it's just a whole building process. And I'll definitely share that. Won't be till that one's the first time we've really done that. Historically, we've just gone out, do drone flyovers and do kind of like videos of the progress, but we're excited for that one.
All right, number 8. Who you surround yourself will either speed you up or slow you down.
Absolutely. I'm just a firm believer in who you surround yourself with is going to motivate you, or they're going to, drag you down to their level. So if you're trying to be a successful entrepreneur and investor, and you're surrounding yourself and your roommates, a person who never wants to start a business, doesn't want to do investing, just wants to live off Social Security when he's older, just wants to live his life on the edge and spend all his money, live paycheck to paycheck, that's going to drag you down. I really believe that, as well as your significant other, your family, the people you surround yourself with. If they're either going to motivate you or they're going to try to take you down to their level, and it's just super important to be cognizant about it. Doesn't mean cut people out of your life if they're that way. Some people have parents that are against what they're trying to do. It just means maybe shorten the time periods with them and make it more intentional. If it's a holiday, but be very intentional about the time you spend with people.
Who are the top 3 people you follow online?
Yeah. Top 3 people would definitely be Brandon. Right now it'd be Brandon Turner. I think that he just lives is building a business similar to mine, but just gives amazing, family life.
Like on LinkedIn or Instagram, or how do you?
All the above. I mean, I listen to his, he just relaunched his, he used to be a Bigger Pockets podcast. He used to be the host of that, but now he's got his own podcast, The Better Life. Amazing. Like, the guy is just an outstanding individual. I've met him here. He's, like I said, I actually sold him his house here, and just a phenomenal guy. Second,
are you going to Maui in May?
I am not. I think he'll do one in Coeur d'Alene, actually. When I sold him his house, he said he's going to do Coeur d'Alene masterminds, and I will for sure go to the one here.
Okay.
I'm going to Limitless in June, and I'm going to San Diego in the beginning of May. So I just have too much travel to go to the Maui one. Are you going to that?
No, I think I'm going. It's a little bit. I'm going to be flying that same week somewhere else, so I can't be there. But yes. All right, keep going. Brandon Turner, number 1.
Second right now, just because it's so important in my life, especially business-wise, is Alex Hormozi. Just his sales tactics and how he's talking about his capital, and I think he's just so real in today's world. I really enjoy him. And then I would say Ed Milet. Ed Milet is just again, an outstanding man. Part of my journey was learning everything about real estate. I'll listen to his real estate, and now there's not a lot of content out there, especially podcasts, that are as granular as Needham. I have a pretty amazing understanding of real estate, so there's not as much knowledge I need in podcasts. So I've kind of moved to like the leadership, how to be a better entrepreneur podcasts and books.
So James Wilson's he's usually on the live with me. We saw Alex in Vegas during NBC. Really? So he was there, and I'm pretty sure he had his nose strips on live. It was crazy. That would have been a giveaway. So I'm not sure if he lives in Vegas, but yeah, his podcast is great.
He does. He lives in Vegas, and he does a lot of stuff down there with Ryan Pineda and whatnot.
Okay. All right.
I haven't seen him, but love to. I want to get him on my podcast.
All right, we'll tag Alex and see if he jumps on the next live here. All right, so number 9, don't wait to get started and wait.
Yeah, I mean, this is in most, every aspect of life as well. Whether or not it's exercise, investing, or starting a business, most people are like, I'm going to do it someday. Where it's just like just getting started, just put $50,000 or $5,000 or $500 investing, and then keep on doing that. You just get the compound effect in everything. Whether or not it's exercise, start going to the gym, once a day, and then you start, the next day you're not going to, but if you wait long enough, you keep on going long enough, you wait the time out, you're gonna see progress in anything in life.
So what would be, if you're, all right, we're gonna go a little bit faster now on these,
okay.
To hit our 30.
Yeah, good.
But what would be your first 3 steps for someone who's interested in development?
First three steps would just be, spend the first 3 months just learning everything you possibly can, reading books, listening to podcasts, everything about development. Second step would be go and reach out to people. Just find their number, call them and ask them to get a coffee. Local developers in your town, get coffee with them. I guarantee you can find multiple people, ask them for advice. And then the third would be, is starting to look for a project, starting to underwrite deals, trying to, find a builder that you want to work with and start underwriting deals, because the more deals you underwrite, the more you understand it, is the more knowledge you're going to be, have behind it. And then, the bonus step would be just getting started on a smaller project. I mean, our first, project was small.
Do you know any big developers or small developers in Texas?
Do I?
Yeah.
No.
Okay. All right. I was just wondering. A lot of the people I know are in Texas, so that's the only reason I ask. All right, let's go. All right, number 10. All right, we'll try to hit these a minute at a time here.
Yeah,
real estate investing, so powerful because it rides out volatility.
Absolutely. I mean, that's why I love it, especially in a market like we're seeing today with the stock market, down, whether it's 40, 50, 60, 20%. Your equity can go down in real estate as it has. Cap rates have gone up. But the nice thing is if you invest in a good, real estate, what we do is, workforce housing, you're still seeing a return on your money. So you're still seeing, let's say it's a 8% cash on cash return, you're still seeing that return, so you can ride out that volatility, pay your mortgage, pay your investors, pay yourself, whatever it needs to be, ride out that volatility when the market goes back up, as it inevitably does the last 250 years of the U.S., as the U.S. has been around. You can sell when the market's up if you want to.
Yeah, I don't know. I can't remember where this quote, it's not quote, but it was basically like a research piece that basically looked at the last, let's say 50 years and every 10-year horizon.
Yeah.
That they took it, like there was a positive return on your money if you invested over 10 years, no matter what year it was. So if it was 2005 and then you had a dip in 2009, you still came out okay in 2015. But as you shorten that up, as you went to 5 years, as you went to 3 years, there was definitely times where you could not ride out the volatility, or if you were forced to sell in that time frame, then you just didn't make money in that time frame. So be able to hold through these times. So I think it's important that it is powerful, but you have to have, it's usually the debt and liquidity at the project level that allows you to ride out the volatility.
Absolutely. Could not agree more. It's the debt. I mean, in real estate, it's the debt.
It's the debt. All right, that's it. All right, we'll just clip that piece and put that on the whole thing. All right, number 11. Good investment will sell itself. You just have to get the word out.
Yeah, I mean, if you have an investment, it's a good location. You perform it well. You have everything that backs every metric that you have, and it's inevitably a good investment that you back it, good track record, and you get it out there. You're able to raise capital and do these different projects. We started with very little connections, but we didn't stop until we found good investments and good opportunities. And when we found those projects, we released them to the world, and the cash started coming in, because there's wealthy people out there and they want to make a return on their money.
How do you get the word out? Maybe give us the top 3 getting the word out.
I mean, historically, was reaching out to connected people, asking them to give us referrals and stuff like that, getting coffee with them. That's been the biggest way. And we'll do emails, text messages, and I call people pretty much every day. I'm the chief investment officer, but I have no problem grabbing the phone and calling investors, and then now we launched this marketing campaign. We get, probably 15 to 20 leads in. I'd say 10 to 20 leads in a day. And I have no problem. We have an investor relations, people on our team, but I have no problem picking up the phone and calling people, because I firmly believe, whether it's email, text, but if you can get the person on the phone, you can. And if you're decent at sales, it's so much better than anything else out there. It's a real personal connection.
I can imagine sitting at the airport, especially in Coeur d'Alene, with all these people coming in from everywhere, like just holding a sign, like I raise money for development. I'm sure you'll get some type of return on that.
I mean, 100%. We're gonna do 2 events this year. One in looking at right now, at least one in Coeur d'Alene and one in Montana. And we're gonna send out 2,000 mailers to homes that are worth $2-3 million in the summertime in Coeur d'Alene, and have a big event here, as well as invite our whole database. If people want to come in, they can all go to it. and we're just going to do an event. So that's the other way we're looking at, you know,
Can
connecting
you
with people.
spell that city?
Yeah.
I'm not from the Northwest. I'm from
See,
Texas.
yes, God's country up here, most beautiful place in the world. COEUR
All
space
right.
D semicolon ALENE, Coeur d'Alene.
All right. I got you. All right. I'm just pulling you up where. All right. All I see, the first thing when I zoom in the map, all I see is a Costco. So
Yep, that's all you need.
if
Costco and a lake.
yeah, if the Costco's there, then I'm in. Let's do it.
I mean,
All right.
there's 5 ski resorts within, you know, an hour of here, and there's big lakes. It's a beautiful here, but they get snow. Well, you guys get snow now too, so.
Yeah, but we can't ski on it, so it doesn't really matter. This is actually when I was looking through your website and stuff, and this is I'm not sure the structure of your company, but it seemed like, how did you connect with your partners? Because this is not one of your top 30, but I thought it'd be a good, because this is probably in that list of, once you do the education, once you start reaching out to people, at some point you probably have to partner with somebody in this business. So
Absolutely.
yeah, so maybe tell that story, because I wasn't clear on how you did that.
Yeah, I'm a firm believer in business partners. I mean, it can significantly fast track you than trying to keep everything yourself. So I actually started in residential sales, and I met my business partner he was doing commercial, I was doing residential. I had a commercial listing. It was my first one. It was just a land listing, and you know, my broker's like, you should partner with a commercial guy. And they introduced me to this other young, you know, hungry guy, and we basically just formed a relationship. We ended up co-listing that property. Talking more. I eventually moved into his office, so we shared an office, and then we ended up forming, you know, the Inland Northwest real estate team. Ended up, you know, combining forces there, selling almost 100 million in real estate, and you know, that was the first business we kind of started together. We actually never sold the original property that we listed together either, and then we took the money we made, the commissions there, funneled it into pretty much, you know, Cornerstone to get that, you know, up and going, hire some employees and stuff. Stepped away from that business, and then we had Cornerstone with John, and then John Senior is actually my business partner I met first. That's his dad. He's been doing this for 33 years, and he's kind of, you know, advisor role. So we brought him on actually as a CEO, because when a company, you know, you look at a company like ours, you want to see experience. You don't want to see a bunch of, you know, 2 young guys. You want to see some experience, some gray hairs, what we call it. And so the 3 of us kind of, you know, they actually had Cornerstone before. I came in as the 3rd business partner, the name and everything. And that's where we really started scaling Cornerstone into what it is today. With the idea, vision of, you know, John Senior's in his 50s. He's done well in his life. You know, he'll step back, and then John and I will run the business to what it's going to be.
Right. No, I think it's always interesting to see how partnerships come together, and usually you work on a project and it's not actually the main project, it's a side project, and then you're like, hey, I actually like working with this person.
Exactly.
And so that was a good tryout. And if that listing failed, even though that listing failed,
Totally.
I mean, and somehow you mentioned Tim Ferriss. One of my favorite quotes from Tim Ferriss is, even if this project fails, what skills and relationships do I take away from it? And so it sounds like, even though that listing failed, you still have your skills and relationships. So
100%.
all right, so let's go to number 12. When you replace your expenses with passive income, it opens your mind to a world you never thought possible. All right.
Yeah, basically, when you invest in real estate, that cash flows we've touched on, when you become financially free, you know, you're able to do whatever you want. It opens you up from, I don't need to work from, you know, 8 to 5 every day if you don't want to. And it opens you up to just the real possibilities of life, and not having to live in this, you know, structure that 90% of the world lives in. You can remove yourself from that structure, and it just really opens your mind to the world.
So if you were not doing development, what would you be doing?
Actually, when I got out of college, my first ambition was to do a tech startup, take that money and invest it into real estate, and then I just got into real estate. But I'd probably go and do a tech startup. I'd dive into that world, because I do find
If
it.
you weren't doing development. Okay.
Yeah,
Right.
I find it fascinating. I do find it fascinating to see what technology is going to have, you know, on development and real estate in general over the next 10 years. I think it's going to completely change the game.
Have you done a post yet on AI's impact on commercial real estate?
A
That is
little bit.
Okay.
a little bit, but I want to do more because, man, I think it's going to be incredibly impactful. I mean, I see if I was if I was in a business, I'd be scared to be a title company right now. I think that whole business is going to be completely changed through AI.
Which company? What type of company?
Title companies.
Title. Okay. All
Title
right.
companies.
Gotcha.
I think
Okay.
it's going to
All
be
right.
really changed.
We'll dig on that a little bit, but if you do you watch there's a podcast called My First Million. Have you heard of that podcast?
I have not.
Okay, so Google that up. My First Million. It's put on by HubSpot, which is like a CRM platform.
Yeah,
But
that's what we use. We use HubSpot.
yeah. So they just did a interview with one of like the CTOs of HubSpot, and he talks about how AI and all these different things, ChatGPT, stuff like that, are going to impact just in general the tech industry. So I would check that one out if you haven't.
Yeah, My First Million.
It's pretty crazy. Yeah, My First Million. Okay, all right. So all right, number 13. Ignore haters. They're wasting time.
100%. I mean, this goes back to the people that will hate something no matter what you do, and you just have to learn to put them away and not dwell on it. I mean, we've gotten called, everything. You're going to talk to investors. You're going to talk to people. It doesn't matter what business you're trying to sell a product. You're trying to originate loans. Someone's going to think negatively of you. They're going to try to tear you down because they're not, where you are. And you just have to learn to ignore it and move on, because you'll have just as many or more people ideally in your circle that are going to promote you and love what you do.
Yeah, I mean, every time we do something, the first version is never that great, but over time it gets better and better and better and better, and then all of a sudden you look back and like people try to catch up to you, and you're too far ahead. So
I mean, I don't know if you guys know who Mr. Beast is, but he's like probably the most famous YouTuber out there. Look at his first video; it was awful, and now he makes the best YouTube videos in the world and makes all this money, and he's the most famous YouTuber in the world.
And people still hate on him for giving money away. It's like,
oh absolutely.
My God. Yeah.
All right. I like this one. Don't find a mentor, attract a mentor.
Yeah, you hear it all the time. I've heard it from, I'm younger, and people are like, well, you have mentors in your life. And I'm like, I didn't have mentors in my life always. My first thing was working hard, proving that I can be successful. And then, providing so much work out there that people want to work with me, because if you can provide value to your mentors as well, through, especially if you're young, hustling and stuff like that, you can attract them rather than try to find them. Because if you constantly try to find them, what's the benefit of them? What's the point of them teaching you if they're getting nothing back? Or if you're providing so much value to them that they feel obligated to provide you some sort of knowledge back, it's just a win-win.
Can you give us an example of something you did that attracted a mentor that other people can do?
That they can do?
Yeah. Like,
absolutely.
Because just use multifamily example. It can be development, it can be value add, whatever. Doesn't matter.
Anthony, and to jump on that, you had posted something about your first experience. You were helping somebody for like $10 an hour, right? So
yeah.
I think this is a great way.
And I'll use that exact example right now. So when I first got into real estate, and before that, I got out of college. I went and started working at a tech startup. 6 months later, I was like, I'm done with this. Like, I was listening to podcasts, way too boring for me. Quit that with no idea what I was going to do, except for I was thinking wholesaling, the Burr method, buy some, single family, move back to Coeur d'Alene. That's where I wanted to live. And I rented a bedroom for like $300 or $400 a month. And I basically lived off like $1,000 a month. And during that time, I was just going to investor meetups, and I met this guy. He never made more than $70,000 a year as a professor in Arizona, but his whole time he'd go to these foreclosure auctions, go to these tax deed sales all over Arizona and Nevada, and he was like 70 at the time. Bought like 230 single family homes that he all had on 10% notes. And I talked to him, I was like, hey, at first, like, I just want to learn from you. I'll work for free, because he was 70 and everything was in filing cabinets. Everything was on paper. And I was like, I can help you organize this, like organize it and make some of it more digital and do that stuff. So I went in there. Eventually he ended up paying me $10 an hour. I was working like 40 hours a week, making nothing. I had 2 degrees, a finance degree and a marketing degree, making $10 an hour, helping this guy manage everything. But in turn, he taught me everything he knew about real estate. I mean, he was teaching me how he bought these properties. We went to tax deed auctions together. He was telling me how, to do the maintenance on this, how to manage stuff out of state. He had, he was managing all this stuff he lives in Coeur d'Alene as well, how to manage it all. and how he built his entire portfolio from, making basically nothing to just snowballing it year after year. And all I provided was helping him get it organized. And by organizing it, he got to spend like half the time in his business, and he was like 70 years old. So that was worth anything to him. But to me, I would have done it for free because how much he taught me.
That is, so you can clip that and just put that as your Rich Dad Poor Dad story right there. That's exactly what Kiyosaki did, right?
Yeah.
So Kiyosaki was working for that guy. He would show up. He would just sit there in the background, doing whatever. He was like scraping gum off the whatever he was doing,
Totally.
everything. And then his parents were getting mad at him because he wasn't making any money, but it wasn't about the money at that time.
Yeah.
It was about the education piece that you were learning.
I was filling out pieces of paper, little ones, and sending certified mail. I'd send like 100 pieces of certified mail, a week, because he had, he was, I wouldn't say he had some tenants that were not, the highest class citizens. He had this whole turnover model where he'd like kick out probably 10% of his units, rebuild the house back, and then resell it. It was this whole process. And yeah, I would just do the most tedious work, but I learned so much, and it really opens your mind. When you do that, I've learned far more than I would say even he knows, and he looks to me for some of his knowledge now. But during that time, is what it really did is it opened your mind to the possibilities of what real estate has to offer.
Yeah, I mean that was perfect, man. All right, let's get 15. Assume you know nothing when at a meeting with someone you admire. Learn everything.
Yeah. So I still do this today, but when I first started, I would reach out to anyone a lot of people I reached out to on LinkedIn. I'd find their email online, I'd find their phone number online, and I'd call them. I've called the biggest developer in town, got a hold of him. His name's Charlie Nip, and I'm like, want to grab a coffee with me? And he's like, who are you? And I tell him, and then I talk him into getting a coffee with me. I sit down for this guy for an hour, and I just like ask him questions and, I try to provide value, because a lot of these people don't have like a good tune on the market. And I try to like have a really good tune on the markets, especially the Coeur d'Alene market. So I try to provide some value, because I just have these little niche things that I scoop out of the air from other like brokers and stuff. And then I just learned so much from this guy who's been developing for 50 years in my market. And I take that and I do that, 50 times a year, and that knowledge compounds.
I don't even, there's so many like small nuggets in there, like in that story. So number one, being able to just not have the fear of rejection, right? Of someone saying no to you a million times. All right. That's number one. Number two is adding value to that person at that meeting, right?
Yeah.
And a lot of people, when they start in this industry, they like, when I started in 2015, 2016, like pretty much every meeting, I knew a lot less than the person sitting across the table every time. And so I was sitting there taking notes, trying to figure out everything, and you're trying to connect the dots. I think the challenge that a lot of new people have is like, they're like, how do I learn underwriting? How do I learn this thing? How do I learn this thing? But then when you talk to somebody who has been in the business, and they're connecting the dots across not only the underwriting, not only the development, not only the market, like they've got the economic piece, they've got the underwriting piece, they've got all those pieces put together. And so it just, when you meet somebody like that, you're like, okay, that guy gets it. And you're trying to absorb everything from that person at one time. So
you learn far more doing that than reading a book. I can guarantee it, especially because, books are just so generalized. They're great. I read a lot of books, but if you can meet someone in your market who's been doing it for 50 years, development for 50 years in your market, guarantee whatever you're going to learn from this guy is far better than what you're going to read about a development book about the US. It is just such good knowledge. And you reach out to these people, especially, being young or not, most of the time they're willing to meet with you.
Well, so we're going to have to do part 2 because we only got the 15. So you have far exceeded my expectations. I had no idea what we were going to get when we got on. So you have done phenomenal.
Appreciate
Anselmo. Thank you for spurring this conversation on. We will set up a part 2.
Perfect.
And hit the other ones. But where can people find more? Obviously, we connected on LinkedIn. What's the best way for people to find you, connect with you, and learn more about your projects?
Yeah, absolutely. LinkedIn is great. I'm on there. That's probably the most active platform I'm on. I really, I like the people that are on there. I'm also on Instagram, Anthony Walker 18. We're going to launch the Wealthy Habits podcast here coming up. And then you can go to www.cornerstone commercial investments. That's our website. And you can, if you want to register as a investor, we'll send you all of our updates and all the stuff so you can get an idea of what we do.
All right. I appreciate Brian Bell with the shout out. Anselmo,
Thank you.
where can people find you? You were the instigator in all of this.
LinkedIn. Hey, I love LinkedIn. It's a great place to connect with all kinds of people, learn a lot of valuable things. Or Velo Residential. That's where I'm at here in DFW.
I love it.
All right, guys. Appreciate you guys coming on. We will set up a part 2 once
Sounds
you're
great.
available, and we'll take it from there. Thanks, guys.
Awesome. Thank you.
All right, see you guys.